A few years back, Business Week magazine published a well-known piece called Earnings Hocus Pocus. It commented that when the economy slows and Wall Street gets jittery, concerns grow that companies desperate to keep up earnings and stock prices practice aggressive accounting, which leads to earnings overstatements in the current year. It went on to comment as well that the aim of today's giant write-offs is to front-load expenses, charge off 3 years of expense all at once, and by definition future earnings will be better. This practice in turn leads to earnings understatements in the current year. Earnings overstatements, earnings understatement. What exactly is going on? How do companies pull this off? And why do companies do it? This video tackles earnings management. What, how, and why. Let's get started by defining exactly what we mean by earnings management. Earnings management is the intentional use of legitimate, emphasize legitimate management discretion to influence the financial statements in a way that achieves a financial reporting goal pursued by management. In this video, we are not talking about fraud, the intentional material misrepresentation of the financial statements. We're talking about the use of discretion available to management in the normal course of business. Discretion when making operating, investing, and financing decisions, and discretion necessary in the estimates, assumptions, and judgments required when making financial statement reporting decisions. Certainly, extreme forms of earnings management can be considered fraud, and unfortunately, reporting fraud does exist in the real world. But here in this video, we focus more on management's decision-making discretion. While what we consider here is not fraud, a key element of earnings management is that it is practiced to achieve a management goal, not necessarily a shareholder goal. And as we learned in earlier videos, management's responsibility is to make operating, investing, and financing decisions that are in the best interests of its shareholders. And reporting decisions should be made in good faith. Thus, whether earnings management is appropriate behavior is a very slippery slope. Nonetheless, it is widely practiced, and savvy business people, they need to understand what it is, how and why it is practiced. It affects the usefulness of the financial statements. With this in mind, let's begin our coverage with a question. What is the proper accounting treatment for research and development R&D costs under both US GAAP and IFRS? The answer, discussed in an earlier video, is that R&D costs should be expensed against earnings, meaning that when R&D costs are incurred, this entry should be recorded, recognizing an immediate expense, which reduces net income on the income statement and either reduces an asset or establishes a liability depending on how the R&D is paid for. The key point here is that R&D costs immediately reduce net income. Given this accounting treatment, let's consider a scenario where you are the CFO for a very large company. The date is December 1, 30 days before year end, at which time the financial statements for the year will be prepared. Last year's earnings, which you want to exceed because it is used as a benchmark to assess your performance, was $840 million. But the internal earnings estimate for this year is only $820 million, $20 million below last year. In essence, it looks like, unless something changes, the company's earnings number will come in below last year. Bad news for the company and you, the CFO. You note further that this year's $820 million annual earnings estimate includes an R&D budget for December of $80 million. And your task today, December 1, is to approve or adjust the $80 million December R&D budget. you figure pretty quickly that you as CFO have an issue to deal with. Do you approve the $80 million R&D budget, or do you cut it to say $50 million, which would reduce the R&D expense by $30 million and boost the annual earnings estimate by $30 million up to $850 million, allowing you to beat last year's earnings, the performance benchmark? If you choose to cut the R&D budget to beat last year's earnings, the earnings benchmark, you are practicing what we call real earnings management. You are making a real decision, operating, investing, or financing decision, to adjust financial statement numbers to achieve a reporting goal. But in doing so, you have disrupted the company's expected future cash flows. In this particular case, you departed from the company's R&D strategy to boost current earnings. That disruption interferes with what the company was trying to achieve with the budgeted R&D amount. There is a real question about whether this budget cut was in the shareholders' best interests. Yes, it did boost current earnings, but at what cost? There are a number of very popular real earnings management methods practiced by companies all over the world today. Some involve managing a company's expenses to affect reported earnings. Some involve managing a company's revenue to affect reported earnings. Others involve managing the timing of recognizing gains and losses to affect reported earnings. Some involve managing the earnings per share number. And still others involve structuring transactions in a way to avoid reporting debt on the balance sheet, a practice referred to as off-balance sheet financing. This particular practice illustrates that the expression earnings management does not always apply to directly managing only the earnings number. It applies more generally to managing any financial statement number. Common examples of real earnings management through expense management include delaying or accelerating R&D investments, which we illustrated earlier in this video. Delaying or accelerating spending on operating items like repairs and maintenance, and business travel and advertising. And delaying or accelerating the start of new projects that invariably include startup costs, many of which are immediately treated as expenses. In each of these cases, the company is departing from normal operating or investing plans in an effort to boost or sometimes reduce reported net income by delaying or accelerating a real transaction which is recorded in this manner. Common methods of real earnings management by managing the revenue number include accelerating or delaying sales efforts like sales promotions and incentives offered to sales personnel, and accelerating or delaying the actual processing of sales orders already received. In each of these cases, the company is departing from normal operating procedures to accelerate or delay either the actual creation of sales revenue itself or the recognition of revenue that already has been created, managing the reported net earnings number by managing the timing of this journal entry. Common methods of real earnings management executed by choosing the timing of the recognition of gain or losses reported on the income statement include delaying or accelerating the sale of non-inventory assets, delaying or accelerating the retirement of outstanding debt, and cherry-picking available for sale securities that have experienced unrealized gains or losses so that realized gains or losses can be booked to affect reported earnings. In each of these cases, the company managers are manipulating the timing of an investing or financing decision in an effort to influence when, this period or next, a gain or loss hits the income statement. Earnings per share, a financial ratio used by many to assess the performance of a company, can be manipulated by purchasing or issuing a company's own common shares. This financing decision directly affects the number of outstanding shares in the denominator of the earnings per share ratio. Finally, off-balance sheet financing is a phrase used to describe efforts by management to keep existing debt from being reported in the debt section of the balance sheet. This is practiced by managers because debt signals risk, and higher risk normally leads to lower company valuations. Examples of off-balance sheet financing include issuing preferred stock with predominantly debt characteristics while disclosing it in the shareholders' equity section of the balance sheet. And another popular practice is to create or invest in separate entities to carry debt on their balance sheets and use the equity method to account for the investment. Later in this video, we discuss this strategy in greater depth. As mentioned earlier, off-balance sheet financing is not designed to influence reported earnings per se, but instead is designed to influence other metrics of company performance related to leverage, such as the debt-equity ratio and the capital structure leverage ratio, total assets divided by shareholders' equity. So, as mentioned earlier, whether these practices are acceptable behavior is a very slippery slope and likely depends to some extent on management's motive. For example, is management practicing this form of earnings management to boost its bonus, to increase personal wealth? Or alternatively, is it attempting to avoid violating the terms of a debt covenant, thus keeping the company from having to incur the cost associated with a technical default? Boosting a bonus is probably not in the shareholders' interest, while avoiding a debt covenant may well be. When analyzing real earnings management, in addition to management's motivation, three key issues should be considered. First, by definition, it involves a real decision that departs from the company's normal plans, and therefore it disrupts the company's expected future cash flows. Second, it is often executed well in advance of the reporting date, which introduces uncertainty regarding whether it will actually achieve the desired effect on reported earnings. For example, reducing the R&D budget by the example we used earlier may still not achieve the reported earnings goal because other unexpected events may occur before the December 31 year-end date. Finally, it does not involve an accounting decision, so it falls outside the scope of the audit and the related accounting regulations. The auditor has no leverage to discourage management from doing it, and accounting regulators have no basis to punish management for doing it. However, punishment can come in other less direct ways. For example, a number of years ago, the Wall Street Journal published an article about General Electric's reported earnings numbers across time. The article graphed GE's reported earnings as a nice, straight, upward sloping line. It went on to point out that during the time period, GE entered into a number of major transactions that directly influenced the earnings number, including debt redemptions, sales of major assets, and restructurings. The timing of these transactions was suspect, because had they been timed slightly earlier or later, the resulting earnings graph would have looked more like this, quite different from the upward sloping straight line. The claim in the article was that GE may have timed these real transactions to create a smooth upward sloping earnings line, which concealed the actual inconsistency in GE's performance. If GE did this, it practiced a form of real earnings management. GE's stock price did not respond kindly to this possibility, and since then management and accounting troubles have plagued the manufacturing and financing giant to the point where GE is now struggling to survive. Let's move on by posing another question. What is the proper accounting treatment for bad debts under both US GAAP and IFRS? The answer, as discussed in a prior video covering accounts receivable, is that an estimate of expected uncollectible receivables is prepared at year-end during the adjustment process, and then an adjusting entry is recorded in this form. Again, let's assume that you are the CFO of a large company. but this time it is December 31, and you are currently preparing estimates for the adjustments required in the preparation of the financial statements as of December 31. The budgeted annual earnings number is $840 million. But as far as you can tell, the actual annual earnings number will be $830 million, $10 million below the budgeted amount. Included in the actual earnings estimate is an $80 million bad debt expense, which was provided by your accounting staff. However, that number is an uncertain estimate that your staff indicates that the actual bad debt expense could be as high as $90 million or as low as $70 million, a range of $20 million. In other words, the estimate is $80 million plus or minus $10 million. Your task at present is to either approve the $80 million bad debt expense estimate or adjust it. If you approve the estimate, the company will fall $10 million short of the $840 million budgeted earnings amount. If you reduce the estimate by $10 million, from $80 million to $70 million, and amount still within the estimated range, it will push the annual earnings estimate up by $10 million to $840 million, and the company will achieve the budgeted earnings amount. If this is your choice, you have practiced what we call accruals earnings management. You have made an accounting choice, estimate, or judgment designed to adjust the financial statement numbers, in this case earnings, in a way that may reduce their ability to fairly represent the financial condition and performance of the company. You may have heard the expression cooking the books. This is an example. Would reducing the bad debt estimate to $70 million so that you could achieve budgeted earnings be lying to the shareholders? In this case, probably not, because technically you chose a number, $70 million, that was within the range of possible outcomes. After all, the $80 million is an uncertain estimate, and you really do not know the correct amount. But you did intentionally choose a number that was both less likely than the midpoint of the range and biased in favor of increasing reported earnings to ensure that the company achieved the budgeted earnings goal. Once again, like real earnings management, accruals earnings management is on a very slippery slope. There are a number of ways in which accruals earnings management can be executed. So let's take a moment to develop a framework designed to organize how it is practiced. The overall question that all reporting processes have to answer is how to account for a given event. First, the financial effect of the event must be judged to be either material, large enough to make a difference to a financial statement reader, or immaterial, too small to make a difference. Immaterial events need not be disclosed on the financial statements or in the footnotes. The problem here is that materiality is very subjective, and that given the size of some of today's corporations, some very large numbers can be judged to be too small to make a difference. That discretion allows management to not disclose some pretty large numbers. And there are documented cases where management has chosen to not disclose some fairly significant bad news items because they were judged not to be material. If the event is judged to be material, large enough to make a difference, management must then decide whether its financial effects should be recognized directly on the financial statements or disclosed in the footnotes. Most reporting regulations that require disclosure do not differentiate between disclosure on the financial statements and disclosure in the footnotes. Either is acceptable. This can pose some challenges for financial statement readers, because important information is often disclosed only in the footnotes, where it can be very difficult to find. For example, Here's the 2017 income statement for Merck, a major pharmaceutical company. During 2017, Merck booked a $191 million loss from the extinguishment of some of its long-term debt. Yet, as you can see, this loss does not appear on the face of its income statement. We can only conclude that it is contained in the account Other Income Expense Net. So we head to the footnotes to find out. Footnote 15 lists the contents of this account. And yet again, we do not see the $191 million loss on the extinguishment of debt. However, we do see an Other Net line, which reads a $304 million reduction in net income. But unfortunately, there's no footnote within this footnote to describe what is included in this number. What to do now? There's yet another angle we can take, because the loss on extinguishment reduces net income, but does not involve an operating cash outflow. This means that it should appear as an add-back in the operating section of the statement of cash flows, which is provided above. Unfortunately, it does not. We can only conclude again that it must be contained in the other category, a $269 million add-back. At this point, you might wonder how we even know about the loss. On page 100 of its 2017 10-K, deep within footnote 10, Merck devotes one short paragraph to the fact that it booked a $191 million loss on the redemption of debt. Reproduced above, the paragraph tells us what we could not find on the income statement or the statement of cash flows, or even in the description of the other items on the two statements. Yes, it was disclosed, but it took a trained eye to find it. And it was for a very significant amount of money, $191 million. Thus, choosing footnote disclosure instead of financial statement recognition is one way management can make material bad news very difficult to find. Which of the many notes to look at? Is it combined with other items in an aggregated account? Is the note even clearly described? These are some of the issues that must be overcome when trying to find important information in the footnotes. If management chooses to recognize the financial effects of a material event on the financial statements themselves, two basic questions must be answered. First, where on the statement should the effects be classified? And second, how should the account values be measured? Or in other words, what monetary value, how much money, should be attached to the event? With respect to classification, classification judgments affect all the financial statements. For example, should income statement items be classified as operating, related to the core activities of the business and expected to occur frequently? Or non-operating, either not related to the core activities or infrequently occurring? Management has been known to judgmentally classify good news items as operating and bad news items as non-operating. Cisco Systems, for example, the well-known computer technology designer, reports restructurings and other charges on its income statement as operating items, included in the calculation of operating income, suggesting that they are a normal part of the business and occur frequently. Disney, on the other hand, includes restructurings and impairment charges outside of the normal and frequent expenses, even though these items seem to occur every year. The same kind of operating versus non-operating judgments can affect classifications on the statement of cash flows. Some short-term liabilities, for example, are considered part of working capital and are therefore included in the operating section of the statement, influencing the net cash from operations number, while others are included in the financing section of the statement. Classification also involves whether an item is classified as a liability or equity on the balance sheet. This judgment directly affects financial ratios like capital structure leverage and debt to equity. So the choice can make a difference concerning how analysts assess the leverage position of companies. Nike, the sports apparel manufacturer, discloses a relatively small redeemable preferred stock issuance as debt on its balance sheet, while Alphabet, the holding company that contains Google, has a convertible preferred stock account listed in the equity section of its balance sheet. Is preferred stock debt or equity? Seems like it might be one of those judgment calls made by management. Another classification judgment affects whether an item is considered short-term or long-term, and again, that choice can affect financial metrics of performance, like the current and quick ratios. Consider the assets section of Merck's 2017 balance sheet. It contains inventories of over $6 billion, but only a little over $5 billion appear in the current section. As Note 7 describes, Merck judged that over $1 billion of the inventory is not expected to sell within 1 year. So it included that amount in the non-current section as other assets. Clearly a judgment call classifying a very significant amount of money. That brings us then to measurement. How management judgment is used to determine the dollar values attached to the accounts on the financial statements. For many companies, the timing of the recognition of revenue is very important and very subjective, and of course this particular management judgment directly affects the revenue number on the income statement, which in turn directly affects net income. Consider again Cisco Systems, a company that provides a broad array of software products, many of which also include long-term service contracts to a variety of customers whose needs are different and constantly changing. An excerpt from its 2018 10-K, which describes these products and services in the highlighted region, is provided above. This variety of products and services raises several key questions regarding exactly when delivery has taken place and its revenues should be recognized. When exactly has the product been delivered in final form? When has the service been delivered and paid for? Answers to these questions are difficult because Cisco maintains ongoing relationships with its clients in a world where technology is constantly changing and new products and services are being considered. As a result, Cisco devotes a full page of its 10-K to its revenue recognition policies and judgments, and like all publicly traded companies, Cisco provides a description of the importance of estimates in the preparation of its financial statements. This description lists revenue recognition at the very top, followed by a number of other important financial statement accounts, including allowances for receivables and sales returns, inventory valuation, loss contingencies and warranties, and impairments and income taxes. The footnote concludes with the somewhat ominous warning that actual results may differ materially from the estimates used in the value of these accounts. Indeed, accounting is not an exact science, and management judgments play a very important role. Once the revenue has been recognized, another subjective estimate involves what expenses to match against the revenues in the calculation of net income. Applying the matching principle involves issues like choosing depreciation methods that require subjective useful life and salvage value estimates. It requires warranty cost and bad debt estimates, as well as questions of whether to expense, book as an expense, or capitalize, book as an asset, certain expenditures. Indeed, there are many areas where management can and must use its discretion when matching expenses against revenues. To provide an idea of how sensitive a company's net income can be to these estimates, let's look at Harley-Davidson, the well-known motorcycle manufacturer. At the end of each year, Harley's management estimates the bad debt expense expected on outstanding accounts receivable. recording the entry above. And it also estimates in advance the costs associated with the warranties attached to the motorcycles it sold during the year, recording the entry illustrated here. During 2017, Harley reported a bad debt estimate of $132 million, which was 2.7% of sales, and a warranty estimate of $97 million, which amounted to 2% of sales, leading to a reported net income number for 2017 of $522 million. Had management subjectively reduced each of these estimates by only 1/2 of a percentage point, the lower bad debt and warranty expense estimates would have led to a net income for 2017 of $698 million, $176 million higher than the actual reported number of $522 million, a 34% increase in net income. 1/2% decrease in the estimates would have led to a 34% increase in reported net income. In another very recent example reported in the Wall Street Journal, Tesla, the well-known electric car maker, which had never before reported a profit, reported its first quarterly profit, an impressive $271 million. Interestingly, this profit was boosted by a big reduction compared to the prior quarter in Tesla's estimated warranty expense. The company justified the reduced warranty expense by claiming that the cars it sold during the current quarter require less maintenance than the cars sold in the prior quarter. But the article goes on to note that many of the analysts who follow Tesla were unconvinced and remain skeptical of Tesla's profit, implying that the company may be practicing accruals earnings management. That brings us then to the final element of subjective measurement, the valuation of assets and liabilities. Two fundamental accounting principles here are the lower of cost or market rule, which essentially says when in doubt, accelerate losses and delay gains, and the contingency principle, which says that losses must be recognized if they are highly likely and able to be reasonably estimated. These two concepts come into play when assets on the balance sheet, like inventories, fixed assets, or goodwill, lose their values, or contingent liabilities like lawsuit settlements or severance payments are created. Retailers, for example, normally write down the balance sheet value of inventories unsold at the end of the season. Companies often book restructuring charges when they plan to close underperforming operations where employees must be let go and facilities must be sold, or in some cases even abandoned. And sometimes acquisitions go south, leading to goodwill write-downs. Basically, if the value of an asset becomes permanently impaired and drops below its balance sheet carrying value, or a contingent liability is created, a loss must be booked on the income statement. The trick here is by how much. How big should the loss be? Assessing the size of the loss and the write-down is extremely subjective because it involves estimating market values and future events, and nobody has a crystal ball. This gives management a huge amount of latitude when making these estimates. Let's take a look at a recent example. Sears Holding Corporation. This company is currently involved in bankruptcy proceedings. For years, it was a mainstay retailer in the U.S., but quickly lost its edge when much of retailing moved to the internet. Management changes and acquisitions like Kmart that were intended to right the ship were unsuccessful, and now, for several years, the company has been closing stores at an alarming rate. These events have caused management to book major inventory write-downs, record frequent restructuring charges, and recognize asset impairments and write-downs, all involving hugely subjective losses recorded on the income statement. Here is Sears' income statement for 2017, 2016, and 2015. Most notably, you see net losses across the last 3 years and a $383 million loss in 2017. Contributing to these losses are consistent impairment charges across the 3 years, and note the $141 million impairment charge in 2017. While these asset write-downs are significant, the real story resides in the footnotes. Let's begin by focusing on the $142 million impairment charge recorded in 2017. Note 12, entitled Goodwill and Intangible Assets, discloses that Sears recorded an impairment related to the Sears trade name of $72 million in 2017, which gave rise to the entry provided above. One legitimately wonders how Sears management justified the $72 million reduction in the value of its trade name. Why not 50 million or 100 million? Very subjective. Note 13, entitled Store Closing Charges, Severance Costs, and Impairments, contains a section devoted to impairments of long-lived assets. This section contains a chart describing the impairment charges for 2017, 2016, and 2015, divided between the Kmart stores and the Sears domestic stores. These impairments led to the entry above, recorded in 2017, and again, one wonders exactly how Sears management came to the highly subjective $70 million number. Accounting principles require that it involves predicting the future cash flows associated with the impaired assets and then applying a discount rate. Again, highly subjective. Together, the $72 million trade name write-down and the $70 million long-lived asset write-down explain the $142 million impairment charge disclosed on the income statement. Note 13 also tells us quite a bit more. It contains a chart listing a number of different kinds of costs associated with the store closings. Included are the inventory markdowns, and the footnote tells us that the $227 million loss is included in the account entitled Cost of Sales, Buying, and Occupancy Merchandise Sales, suggesting that the write-down was recorded in this way, increasing cost of sales on the income statement. The chart also indicates that the cost associated with employee severance, the termination of facility leases that by contract still must be paid, and other charges total $235 million and are included in the income statement in the account Selling and Administrative, suggesting that Sears recorded this entry. And finally, the impairment and accelerated depreciation category included a $40 million asset impairment that was recorded as accelerated depreciation and therefore was included on the income statement as additional depreciation expense, recorded in this manner. To summarize, Sears' 2017 income statement contains $644 million in charges associated with highly subjective, unusual, and non-reoccurring write-downs and contingent liabilities. $142 million in direct asset impairment charges, $227 million included in cost of sales, buying, and occupancy due to inventory write-downs, $235 million included in selling and administrative expenses due to employee severance packages, future contractual lease payments that need to be made, and other items, and $40 million of additional asset impairments recorded as extra depreciation. The $644 million total far surpasses the company's 2017 bottom line net loss of $383 million. The example of Sears Holding serves as another reminder that accounting is certainly not an exact science, and that management's biased judgment often play a huge role. Let's go back and briefly summarize the accruals earnings management framework. First, the financial effect of the event under consideration must be judged to be material or not. If the financial effect is judged to be immaterial, no disclosure is required. If the financial effect is judged to be material, management must choose whether to recognize it on the financial statements or simply disclose it in the footnotes. Footnote disclosure requires judgments about where and how to represent the information, and the financial effects of events represented on the financial statements must be properly classified and measured. At each of these decision points, materiality, disclosure, classification, and measurement, management makes judgments. Judgments that are invariably influenced not only by how well they represent reality, but also by the consequences they bring about. We now move to a discussion of why earnings management is practiced, how it is practiced, and the common strategies used by management when it is practiced. Understanding these issues can help financial statement users recognize the situations when earnings management is likely and recognize how and where earnings management is affecting the financial statements. Earnings management is practiced because achieving or not achieving earnings benchmarks or earnings goals is very important to management because there can be very significant consequences. Many large publicly traded companies, for example, are under pressure to achieve earnings forecasts published by analysts who follow them because it has been shown repeatedly that the company's stock price, a key measure of management performance, is very sensitive to whether the forecasts are achieved. Not achieving the forecast disappoints investors, which tends to drive down the company's value. Management compensation is often based on achieving earnings goals, so the bonuses paid to the company's managers may depend on beating an earnings benchmark. Companies commonly establish in advance monthly, quarterly, and annual budget goals, and whether a company meets these goals, often measured in terms of earnings, serves as an important measure of management success, which in turn may drive bonuses and stock prices and cause other consequences. Debt covenants often contain requirements expressed as financial numbers or ratios that, if unmet, can lead to costly technical defaults. Industry statistics are sometimes used as benchmarks, and sometimes goals as simple as last year's earnings or reported earnings greater than zero, that is, avoiding losses, may serve as important benchmarks. Clearly, a variety of possible benchmarks exist, and financial statement readers should try to assess which of these goals are important to management in a given situation. Such knowledge may help to indicate whether the company is managing earnings and in which direction, up or down. How do companies manage earnings? To review what we have covered so far in this video, there are two basic ways: real earnings management and accruals earnings management. Real earnings management involves actual operating, investing, or financing decisions designed to influence the reported numbers. Accruals earnings management involves discretionary accounting choices, estimates, or judgments designed to influence the reported numbers. Real earnings management disrupts the company's future cash flows and may or may not achieve the earnings goal, but it is relatively easy to practice because external auditors and regulators have no authority over how companies make real business decisions. Accrual earnings management can be exact, and normally it is executed at the end of a reporting period, but auditors and regulators exercise oversight over accounting choices. So if accrual earnings management is detected or even suspected, significant negative consequences may follow. That brings us then to the common strategies used by management when practicing earnings management. There are three well-documented strategies: overstate current financial performance and condition, understate current financial performance and condition, and off-balance sheet financing. Overstating current financial performance and condition is probably the most well-publicized. It often occurs when companies are struggling and need, sometimes desperately, to maintain their stock prices and/or sources of financing, or obtain additional financing. Using earnings management to boost their financial statement is often viewed as buying the time needed to fix the problems and get their businesses back in order. A recent example, referred to earlier in this video, is Tesla, the electric car maker, who helped to push its profits above zero for the first time by reducing the estimate of the expected warranty costs associated with its car sales. In essence, it may have been overstating its current financial performance by using accruals earnings management to beat a zero profit benchmark. The second strategy, understating current financial performance and condition, tends to be practiced by companies that are having either very good or very bad years. Those having very good years understate earnings to build what we call hidden reserves, while those having very bad years understate earnings by what we call taking a bath. In both cases, the understatement in the current year naturally helps to boost the reported performance of future years. An example of what could be considered building a hidden reserve can be found on AT&T's 2017 income statement, which is provided here. Note that 2017 was a very good year for AT&T, in that its net income of almost $30 billion more than doubled the net income reported in the prior 2 years, both of which were around $13 billion. Interestingly, we also see in 2017 a charge against income of almost $3 billion for asset abandonments and impairments. The 2017 amount was much bigger than either of the prior years. Further, we also know that this charge or expense involved no cash payments because the operating section of AT&T's statement of cash flows shows that the entire $2.914 billion amount was added back to net income in the calculation of net cash provided by operating activities. Thus, AT&T must have recorded this entry at the end of 2017 based on future plans to shut down certain facilities. This is a highly subjective estimate based on uncertain future plans for a very large amount, and AT&T chose to record it when it knew it had had a very good year. This choice by AT&T's management served two basic purposes. It reduced current net income at very little cost because it had had such a good year, which in turn reduced a benchmark for next year, last year's earnings, making it easier to achieve, and it also removed the need to depreciate or write down these assets in future years, which naturally boost reported income in those years. Indeed, this is a candidate for using accruals earnings management to help achieve future benchmarks. An example of taking a bath can be found if we look at Volkswagen, the German auto manufacturer. In 2015, it was discovered that Volkswagen had falsified reports indicating that its diesel engines were violating emission standards. This development introduced huge future costs to the company in the form of potential litigation, regulatory fines, and automobile recalls. According to accounting principles, Volkswagen was required to estimate and book expenses for these future costs in 2015 in the form of a large write-off, even though these costs would extend over at least the next several years into the future. An extremely subjective estimate. It was clear that 2017 was going to be a very bad year for Volkswagen, and because the fraud was well publicized, the whole world expected it. The write-off, which would look something like this, accruing a liability and reducing the value of assets, would be huge. And because it involved future uncertain costs, the amount would be very subjective. So, what better time to add a few extra expenses to the amount of the write-off? Expenses that VW would not have to book in the future, which would naturally boost future earnings and make it appear as though the company is rebounding quicker than perhaps it really is. Adding a few $1 billion to what was already going to be a huge number would hardly be noticed by the outside public. Why not take a bath in 2015? We turn to Volkswagen's 2015 income statement, which is prepared according to International Financial Reporting Standards, IFRS, and denominated in euros. We see that it reports a loss of 1.361 billion euros in 2015, compared to approximately an $11 billion euro profit in 2014. To find out more about this big drop, we go to footnote 30, which explains the activity in the provisions account, which is what we call in the U.S. contingent liabilities, which appear on the balance sheet and according to U.S. GAAP and IFRS must be accrued if they are highly likely and can be reasonably estimated. We focus on the activity during 2015, which is contained in this box. It highlights a beginning balance on January 1 of 2015 of almost 33 billion euros and an ending balance on December 31 of almost 51 billion euros, a whopping increase of about 18 billion euros. This large increase is a result of a net increase in the liability account of about 29 billion euros, 31 billion additions minus 2 billion reversals, and the liability was decreased by about 11 billion euros, the cash payments called utilized in the note made to pay off the liabilities during the year. With this information, we can then recreate the write-down entry recorded by Volkswagen, which is provided here and comprised basically of two separate entries: the accrual of an expense of 29 billion euros and the net addition, 31 billion minus 2 billion, to the liability account, and an 11 billion euro cash payment made to reduce the liability. Combining these two entries leads to a 29 billion euro expense, 18 billion euro increase to the liability, and an 11 billion euro reduction to cash. Volkswagen used the term provisions instead of contingent liability. This term is often used in Europe to describe the idea that a provision is now being made for a future cost. This 18 billion euro accrued liability represents the part of the expense write-down that required a huge amount of judgment, and it would have been relatively easy for the company to add a few extra billion euros to this estimate. Returning to Volkswagen's income statement, we see large increases from 2014 to 2015 in three accounts. Other operating expenses from 7 billion to 20 billion euros, about a 13 billion euro increase. Cost of sales from 166 billion to 179 billion, again about a 13 billion euro increase. And distribution expenses from 20 billion to about 23 billion, about a 3 billion euro increase. These three increases total about 29 billion euros, which matches the additional expense recorded in the write-down entry made by Volkswagen. This enables us to see whether most of the write-down is reflected on the income statement. To complete the analysis, we take a look at the operating section of Volkswagen's statement of cash flows. Similar to U.S. GAAP-based cash flow statements, it starts with earnings. Earnings and taxes are broken out in this case at the top, and then follows with the adjustments necessary to compute cash flows from operating activities. Note that one of these adjustments, the largest by far, is an 18 billion euro add-back entitled Change in Provisions. This add-back represents the non-cash or accrued liability portion of the 29 billion expense in the write-down entry recorded by Volkswagen. Again, here is where the company may well have added a few extra billion euros. following a take-a-bath strategy. So, given that Volkswagen may have taken a nice bath in 2015, let's take a look at how the company has done since 2015. We see that Volkswagen booked a profit for 2016 of 5.4 billion euros and a profit for 2017 of 11.6 billion euros, showing a huge rebound from 2015. One wonders what portion of the 2016 and 2017 profits are due to expenses booked in 2015, the bath year, that otherwise would have been booked in 2016 and 2017. This brings us to our final earnings management strategy, off-balance sheet financing. Here the idea is not to manage the earnings number, but to avoid reporting liabilities on the balance sheet. While borrowing, the use of leverage, can be a very useful management tool, it does impose contractual obligations to pay cash in the future, increasing the company's risk of failure. Off-balance sheet financing strategies are used to reduce the public perception of that risk by reducing financial ratios like capital structure leverage, total assets divided by shareholders' equity, as well as the debt to equity and debt to asset ratios, all of which are used by investors to assess company risk. Off-balance sheet financing can take many different forms. Until recently, perhaps the most common form was to choose operating lease treatment instead of capital lease treatment when leasing assets for long periods of time. Operating lease treatment books the lease payments as simply lease expense, keeping the leased asset and related liability off the lessee's balance sheet. Capital lease treatment, on the other hand, requires the lessee at the beginning of the lease to recognize usually a large asset and treat the future contractual lease payments as usually a large long-term note payable, a liability, on the balance sheet. However, a recent accounting standard, adopted by both US GAAP and IFRS, and effective January 1 of 2019, requires all leases over 1 year to be treated as capital leases. This new standard has pretty much eliminated this form of off-balance sheet financing. Another popular off-balance sheet financing strategy is to pursue projects that require financing by creating or investing in separate entities that carry the debt created by the financing on their balance sheets. The separate entities are often called special purpose entities, SPEs, and such arrangements are often pursued by more than one company through joint ventures. The equity method of accounting makes this possible. So a fairly simple way to avoid carrying debt on the balance sheet is to use the equity method instead of consolidation when accounting for major investments in the equity securities of other companies. Under the equity method, which is normally used when purchasing from 20 to 50% of the equity securities of other companies, called affiliates, only an investment account is increased when the equity securities are purchased. No liability appears on the purchaser's balance sheet, even if the affiliate is highly levered. Thus, by using the equity method, a company can acquire a significant interest, if not control, in another entity and not have to report the entity's liabilities on its balance sheet. Under consolidation, which is normally used when over 50% of the stock is acquired and there is control over the investee company called a subsidiary, the assets and liabilities of the subsidiary are consolidated with or added to those of the parent as if this entry was recorded by the investing company. With this information, suppose that two companies, A and B, together initiated a costly project that required financing by creating a separate entity or special purpose entity where each of the companies invested a relatively small amount, say $5 million, in exchange for 50% of the stock in the SPE, a 50-50 joint venture. the SPE would record the transaction as an equity issuance for $10 million. And each of the companies using the equity method to account for the investment would book the $5 million cash payment as a long-term investment. The jointly owned entity, the SPE, could then borrow the money necessary for the project, say $100 million, and use the funds to invest in the project. Note importantly that the SPE would carry the debt and the assets on its balance sheet, while the companies A and B in the joint venture would share the profits or losses without recording any debt on their balance sheets, thus achieving the goal of off-balance sheet financing. This problem is inherent in the equity method of accounting. If we take a look at the 2007 balance sheet of Walt Disney, for example, we see an investment account with a September 30, 2017 balance of $3.2 billion. Footnote 5, entitled Investments, shows that almost $3.1 billion of that amount contains investments accounted for using the equity method. The footnote further explains the nature of these investments, where Disney holds significant equity interest in other companies, one of which is A&E, where Disney is a joint 50-50 owner with another entity called the Hearst Corporation. Under the equity method, the liabilities of none of these companies appear on Disney's balance sheet, even though Disney has at least significant influence, if not effective control, over these entities. Fortunately, accounting standards require that summary balance sheets and income statements for all affiliate companies be disclosed. So footnote 5 also includes this summary of the combined statements of all of Disney's affiliate companies, A&E and the others. You can see that together these entities carry a little over $9 billion of liabilities on their balance sheets, resulting in a liability to total asset ratio of about 62%. Interestingly, a look at the liability and equity side of Disney's 2017 balance sheet tells us that it carries total liabilities of $50.785 billion and a liability to total asset ratio of 53%, which happens to be less than the 62% combined liability to total asset ratio of the affiliates. Thus, if the affiliates were consolidated with Disney's financial statements instead of using the equity method, Disney's liability to total asset ratio would rise above the current 53%. Finally, keep an eye out for preferred stock issuances as a way to avoid reporting debt. Preferred stock terms can sometimes look a lot like debt. No vote for the board of directors, fixed dividend payments that look a lot like interest, and priority over common equity in the event of liquidation. Recall that earlier in the video we showed you the balance sheets of Nike, the sports apparel manufacturer, and Alphabet, the holding company that contains Google, the internet giant. Nike discloses a relatively small redeemable preferred stock issuance as debt on its balance sheet, while Alphabet has a convertible preferred stock account listed in the equity section of its balance sheet. As a result, it makes good sense to take a close look at the terms of preferred stock issuances to ensure that they are being classified correctly, especially when they are classified as equity. We have concluded our coverage of earnings management. In summary, the video course contains two parts: methods of earnings management and an earnings management framework. In the first part, we drew a distinction between real earnings management and accrual earnings management. Real earnings management involves actual operating, investing, or financing decisions, while accrual earnings management involves accounting judgments, estimates, and choices, entailing many different judgments, including whether the financial statement effect of a transaction is or is not material, whether a material transaction should be reported on the financial statements or footnotes, and if reported in the financial statements, the financial statement effects must be both classified and measured correctly. Measurement involves judgment in the areas of revenue recognition, matching expenses to revenue, as well as asset and liability valuation. The earnings management framework included 3 parts. Why is earnings management practiced? How is it practiced? And what earnings management strategies are used? Earnings management is normally practiced to achieve any of a variety of benchmarks. Earnings management is practiced using real and accrual-based methods. And earnings management strategies include intentional overstatement, making performance look better in the current period; intentional understatement, making performance look worse in the current period by either building hidden reserves or taking a bath; and finally, off-balance sheet financing. In conclusion, savvy financial statement users must maintain a healthy skepticism of the financial statements because they are prepared by management, who must use its judgment when making real business decisions as well as accounting choices. And sometimes these judgments and choices may cause the financial statements to depart from their primary goal: to report the performance and condition of the business as accurately as possible.